kind of call it win-win, because it's better for the underwriters to appreciate and understand the risks that they're pricing, and also not be intimidated by the wrong assumptions. Because I'm finding that's the biggest challenge. As we were talking about this, alternative technology, immediately the engineer started describing his experience with the technology, which was a completely different industry, completely different type of technology, but it suddenly sounded really scary. And then I said, "Oh, actually, for us, this technology application is completely different. Instead of 30 meters, it's 1 meter high. Instead of heavy acids, it's a fertilizer. Just completely different worlds." And that puts underwriters' mind immediately to rest, because they go, "Oh, okay, it's not actually increasing our portfolio exposure that significantly." And it's a win-win for us, because we want to be priced on our underlying risk. We don't want to be priced on some hypothetical, Brazilian mining risk that somebody somewhere has imagined in their head. So yeah, I was actually, today was surprisingly enjoyable, because what I thought would be like a quick formal conversation actually turned out into this, light bulb moment, going like, "Oh, that's why Psi AI exists, because we really need to not just capture the risk profile once, but we really need a place to constantly update what's happening to the risk profile, new um, new technologies, actual equipment performance, incident rates, just everything that happens throughout the year significantly shifts the needle." I mean, for us, again, this is so huge that since my previous policy initiation date, US government essentially went out and started creating a whole new alternative market for the rare earth minerals, and they've been quite successful at doing that, by establishing floor prices, by building demand, by speeding up processing capability. Both in US and the European governments are kind of doing the same thing in the Australian government. So in a year's time, the whole industry changed so dramatically, and that obviously has a huge impact on our BI exposure, because in the past we had limited number of clients that were paying specifically kind of indexed price with lower volatility. Now we have a lot more upside, but that means, as a business, this is an amazing place to be in. But also, what this means is that our insurable losses are significantly greater as well. So we need to now make sure that our policy essentially catches up with what's happening in the market. So the market has grown so significantly. We now need to make sure that the policy kind of steps up. Now, the good news is that because we're good at risk management, we knew this would happen. So we anticipated it back when we did the initial policy. And I am 90% sure then when we do the whole recalibration and reassessment, our existing limit and our existing assumptions in the policy would be still sufficient, even under a completely different market reality. I'm 90% sure, because we've really built into that volatility into the original conversation, because that's exactly how we were discussing it. Like, what happens if the market changes? Is this policy still going to be a good fit? But by the way, again, not something a traditional insurance conversation would have, because the underwriters asked us for our revenue projections, and the revenue projections are coming from a financial model, and a financial model comes from an approved budget, and approved budget usually comes from something that the board and the shareholders have agreed upon, and that is usually based on some sort of very stable, solid assumptions. So if there is a small probability of huge market shift and a completely different game, that wouldn't be in your budget, because it's a small probability scenario. It's not your main base case. Your main base case is what you have in the budget. So if we went down the route of traditional approach of saying, give us your revenue projections for the next few years and use that to calculate BI, our existing limits would have been significantly lower than what it is today, and then we would most definitely be underinsured given all the changes that have happened. But because we didn't look at just the base case scenario, but we also looked at plausible alternative scenarios when we were negotiating the original limits, our original limit was already built with enough headroom for that upside scenario, which happens. So good world to be in when upside scenarios happen.